Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for the week of August the 20th, 2012. The biggest development last week was the broad-based sell-off in the Japanese yen, which followed a rally in US Treasury yield based on receding expectation of additional easing from the Fed. Another development to note was the Aussie dollar's decoupling with risk markets, with the sell-off intensifying after the Treasury noted that the Reserve Bank of Australia could cut rates due to the currency's strength. The euro, on the other hand, remained steady, with Japanese yield continuing to dip on expectation of the European Central Bank's actions in September. And the sterling was supported by solid economic data from the UK. Nonetheless, strength in European majors was generally limited. Technically, while stock markets extended the recent uptrend, with the S&P 500 edging higher to close to 1418, we'd maintain our view that a reversal is imminent, as it should face strong resistance from a 1422 high. And should stocks reverse, the already weak Aussie will be sold off deeper, and such developments could limit the yen's weakness. Even though we're favouring more upside in the European majors, the current developments don't give us much confidence. Firstly, we'd prefer an Aussie dollar US dollar short in near term. Secondly, whilst we're also favouring a US dollar Japanese yen long, we'd be cautious as it hits the 80 psychological level. Thirdly, we'd avoid European majors for the time being. Recent economic data from the US was mixed to positive, with strong retail sales in July, even though regional Fed surveys disappointed. A key event ahead this month is Fed Chairman Ben Bernanke's speech at the Jackson Hole Conference on August the 31st. However, recent developments dented the hope of Bernanke announcing anything significant in this traditionally important event. Although the markets are still leaning towards the case for the Fed to do another round of easing, this will require some substantially weak economic data to push them to act. The receding expectations of a third round of quantitative easing from the Fed was clearly reflected in the surge in the Treasury yield last week. 10-year yield jumped to close at 1.816% compared to the prior week's close of 1.649%. The move was even more impressive when compared with the intraday historical low of 1.394% made on July the 24th, that is less than a month ago. 30-year yield rose to close at 2.934% compared to the prior week's close of 2.806% and an intraday low of 2.452% made on July the 25th. The jump in yield pushed US dollar Japanese yen and other yen crosses higher, with the US dollar Japanese yen set to take on the 80 psychological level soon. The Bank of Japan minutes also exerted some pressure on the yen. Minutes of the July the 11th meeting unveiled that a few members warned that Japan's economy could be adversely affected through various channels if, for example, a substantial risk materialized stemming from the European debt problem. These members urged the bank to stand ready to take appropriate actions without ruling out any options in advance. Nonetheless, the bank's view is that growth prospects will likely remain broadly unchanged. Regarding inflation, CPI is expected to be broadly in line with April forecasts. At that meeting, the Bank of Japan voted unanimously to keep rates unchanged at 0 to 0.1% and maintained the scale of the stimulus program to 70 trillion yen. Japan's GDP grew only 0.3% quarter-on-quarter in the second quarter of 2012, well below expectations of 0.6% and 1.2% in the first quarter. The major disappointment comes from weak consumer spending. Although the government has been given subsidies on a number of green products since the earthquake last year, the impact on stimulating spending has been limited. As the positive effects of the subsidies fade, Japan's consumption outlook is expected to weaken further in coming quarters, an outlook that would hurt investors' confidence. In the Eurozone, Spanish 10-year yield dipped further to settle at 6.443% last week and is now comfortably below the 7% unsustainable level. Spanish bonds were supported by news that Spain is ready to seek a sovereign bailout at a meeting of finance ministers next month. And as Spain requests aid, the European Central Bank would restart bond purchase as part of an overall package. It is also reported that Spain's Bankia will soon receive an emergency disbursement from the €100 billion bailout programme, due to the dropping of plans for Bankia to get a loan from the ECB due to restrictions imposed on bank borrowings. Meanwhile, sentiments were generally lifted after German Chancellor Merkel voiced her support to the ECB's effort on fighting the debt crisis. Merkel stated that policymakers feel committed to do everything they can in order to maintain the common currency. She also affirmed that Draghi's decisions have made it clear that the ECB is counting on political action in the form of conditionality as the precondition for a positive development of the euro. These comments indicated that Germany has moved away from the opposition position over the ECB's purchasing of Spanish and Italian bonds, and further affirm the chance that the ECB will be acting soon. There are risks to note as that Greek Prime Minister Samaras, facing deepening recession in the country, is set to meet with Luxembourg Prime Minister Juncker, German Chancellor Merkel and French President Hollande next week to try and persuade the Eurozone leaders to extend the time of austerity from 2 years to 4 years up until 2016. Meanwhile, Eurozone data showed French GDP was flat quarter on quarter in Q2 compared to expectations of a 0.1% contraction. German GDP grew 0.3% quarter on quarter compared to a consensus of 0.1%. Greek GDP contracted 6.2% year on year in Q2, suggesting the recession continued and implementation of fiscal austerity measures would be more difficult. Eurozone Q2 GDP showed a contraction of 0.2% quarter on quarter as expected. The August Bank of England minutes indicated that policymakers voted unanimously to leave the rate unchanged at 0.5% and adopt no change in asset purchases. Yet it also unveiled that some members favoured more easing. Unlike previous minutes, the August one did not hint that the bank is biased for further rate cuts. We believe they would gauge the impact of the new funding for lending scheme before implementing additional easing measures. As such, the most likely timing of further easing would be in November, when the £50 billion of asset purchases are completed and the impact of the funding for lending scheme would be reflected in the economy. Economic data from the UK was also solid. Claimant count unexpectedly dropped by 5,900 in July, and unemployment rates also unexpectedly improved to 8% in June. Headline retail sales rose 0.3% month on month and 2.8% year on year in July versus expectations of 0% month on month and 1.5% year on year. Ex-auto fuel sales was flat month on month and rose 3.3% year on year, also better than consensus of a 0.2% contraction month on month and 1.7% growth year on year. CPI unexpectedly rose back to 2.6% year on year in July, while core CPI also rose back to 2.3% year on year. Both were much higher than expectations of 2.3% and 2% respectively. RPI also beat expectations and rose more than expected to 3.2% year on year. The Australian dollar dipped sharply against the US dollar after an Australian Treasury report noted that the Reserve Bank of Australia could cut rates further on the Aussie's strength. The report noted that the Aussie is well above its post-float average and is overvalued compared to its medium to long-run equilibrium level. While Treasury economists thought that intervention might lead to market instability, they do believe that there is room for the RBA to cut rates if the strength of the Aussie inflicts too much pressure on the economy. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, Join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.